Good morning, everyone. I'd like to introduce myself. My name is Marion Guerrero from the Client Success Department. I would like you to welcome to this webinar, Tax and Economic Trends for 2025. To begin with, it is my pleasure to introduce our today's speakers. Arnoldo Rodriguez, tax partner at our Monterrey office. Blanca Montaño, tax partner at our Tijuana office. Rolando Diaz, labor senior director at our Guadalajara office. And Montserrat Colin, partner of International Tax and Transaction Service at Ciudad de Mexico office. Okay, so thank you very much for your time. Now let's get started our webinar, and I will pass the microphone to our speakers.
Good morning. As Marion was mentioning, my name is Arnoldo Rodriguez, tax partner at the Monterrey office. And what I will be talking here today are the trends that the tax authority has been carrying during this year and what we are expecting for the following year. In this particular case, the tax authority has been carrying some reviews and some analysis for the taxpayers in order to make good conducts about how to pay taxes. And so in some cases, the tax authorities may suspend what we call the digital stamp certificates. What does this do is that they pause the operation of the taxpayers in case that the tax authority has detected that the taxpayers has been carrying some simulated operations with another taxpayers. So this may create a conflict on the operation of the company. Also, as you may know, here in Mexico, the returns are electronically submitted, right? So the tax authorities has in real time knowledge when a taxpayer has not been submitting the returns in time, and it is very common to see that the taxpayers may receive an invitation or a notification when a due date is not being met and has not been submitted, right? So it is very important to keep this in mind, to have in mind the due dates that we have enforced. And most recently, and as you may know, we have been introduced, or the tax authority has introduced into their system, into their activities, what we have seen is the artificial intelligence or learning machine. What the tax authority has been carrying with this is that they have been putting information about trends, about operations, about taxpayers, in order for that machine to detect bad behaviors or something not normal within the taxpayer. So this gives them a little bit about sensibility who has or who may be exposed to a tax credit, and that's when the taxpayers may receive a notification or invitation letter in order for them to approach them. So if we move on a little bit to the next slide, as we have the master plan that the tax authority shared with everyone, this is a public document, and they stated that the main activities or sectors that they will be focusing in is the automotive sector, construction, electronics, digital platforms, logistics, and among others. These are the main ones that the tax authority will start looking a little bit more attention to, because they have been seeing that there are some trends in which they have been detecting some not a good tax conduct within them, right? And here's a very simple graph of the tax authority that shared how has been the tax recollection on this. And as you may see, we have, well, almost 12 years here in the graph, right? And as you may see, it has been increasing. So the tax authorities during this last president that went out of office couple of months ago, or last month ago, it has been carrying some major activities or more activities regarding tax recollection. So as you may see, 2024, this graph states just as June 2024. So we may expect that 2024 exceeds a little bit more than 2023. So this trend will be maintained, or we expect that this trend will be maintained to 2025, right? So if we move to the following slide, also, what are the notifications that we have seen that the tax authorities has been sharing to the taxpayers? Well, the main ones that we have seen is that they detect difference between the annual tax return and the income that it has been declared. As you know, invoices is also electronically invoiced, so the tax authority has in real time any kind of operation that taxpayers has been carrying. So it is really easy for them to match up the sum of all invoices. And in case that they detect a difference, they can issue an invitation, right? Also, the discrepancies or difference also for the expenses, not just for the income. So also the tax authority may share an invitation for these matters. And the payroll receipt or payroll stamps, also this is electronically issued. So on the monthly returns, the amounts that has been submitted in such returns, they will be compared to the payroll receipt in order to sum the sum of operations. And if there's a difference, the tax authority may detect or may issue also an invitation. And obviously, as you may know, we have here in Mexico blacklist of taxpayers that the tax authority already detected that they may lack some kind of activity of operation that they cannot support, and they blacklist those taxpayers. So if another taxpayer carries an operation with those blacklisted, also the tax authority can approach the taxpayer in order to review that operation, and it may claim it as non-deductible. And also, and regarding and related to the artificial intelligence, they can review and analyze the behavior that the taxpayers has been carrying within months or within last year in order to see a trend or a behavior of income of or expenses that is unusual for them. So it can also approach the taxpayer for this matter. If we move to the following to the following slide, well, what are the recommendations for these invitation letters? Well, the idea this, and let's start by what is an invitation. The invitation is a notification given by the tax authority to the taxpayers, not in a formal way, but more in a friendly manner. And the idea is to clarify this situation without opening a formal audit or a formal procedure. So our recommendation to our clients is to submit or clarify this difference or this situation that the tax authority may have detected, right? And also, in order to do so, we recommend our client to share with them working papers, accounting reports, agreements, payment receipt, reconciliations of difference. Well, these will make what we see in the trend of the tax authority as materiality. So in that sense, the tax authority will confirm or may state or will be comfortable that the operation that they have detected is real. So they will not give or proceed with a formal procedure. And what may happen if we don't attend these kind of invitations, well, they can suspend the digital stamp certificate that we were mentioning before, and or they can also open a formal procedure with the taxpayer in order to analyze, and in such case the tax authority may state or may declare or a tax credit. If we move a slide. And as I was mentioning before, part of this recommendation is that they do not constitute a formal verification process. This is a friendly matter. Let's say that this is a first step to opening a formal procedure, right? So we recommend to attend it no later than 15 working days in order for the tax authority not receive a response, and that they may think there's a thing or a difference there that they can came up or can review later on to the taxpayer. Also, this clarification is made through the tax authority web portal or website, and if by clarifying it, the tax authority is not obligated to share or to share a response on this or to make a position on this. So it is very common that taxpayers actively submit this information to the tax authority, the invitation support, but the tax authorities do not have an obligation to share with them if it was reviewed and if the case was closed. So this is not a requirement for them, right? And what they can determine and what may happen is that they can open it a formal procedure. If this is not answered, there can be a tax credit, penalties also can be incurred, and a suspension or a cancellation regarding the digital stamp certificates. If we move to the following slide, please. And what are the behaviors or the activities more in detail of what the tax authorities has been detected on the taxpayers that has been carrying some operations that the tax authority do not like? Well, they have seen that taxpayers has been carrying some kind of payments or operation or plans for their employees that assimilate those operations to salary instead of doing the correct or the stated way on the law. Also, corporate restructures in which they can get some benefits by carrying some mergers or spin-off regarding international structures. Intangible sales, they are also on review. This is very important. We recommend that transfer pricing and a tax team to follow or to assist on these manners, and that some applications regarding VAT, some applications of different tax rates as we have here in Mexico regarding VAT, that they have been applying some rates that do not correspond to that operation. That is very important. And some improper application of tax stimulus that we have in place. And as you have seen, Mexico has been very progressive on the recommendations that the world has been sharing regarding international taxes. So the abusive use of tax treaties has been also under the review of the tax authorities, and it has been also paying attention to foreign trade, to customs operations that has not been following the returns and the information to be shared on normal basis or what it is stated in the law.
Hello, good morning. My name is Rolando Diaz. I'm Senior Director at J. Del Rio, and I'm going to explain the labor reforms and initiatives for this webinar. And first of all, I would like to start by commenting that in the last few years, there have been several labor reforms in Mexico. Probably the most important was the ban on the outsourcing services back in 2021, which affected many companies that used to hire employees through an outsourcing agency. Currently, all the employees who participate within a company must be hired directly, except for those employees who provide specialized services through a service contract. In addition, we also saw new regulations related to remote work, profit sharing, which was capped, the increase in vacation days, and new obligation to avoid work stress for the employees. For this presentation on the labor side, we will have a quick review of the latest changes that we faced during this year. And then at the end, we would talk about the labor reform initiatives for the next year. Next slide, please. Well, back in February, the new rules regarding the renewal process for the REPSE registry were published. The REPSE registry is only valid for 3 years, and since this obligation was created in 2021, in 2024, it's necessary to renew those registrations. Obviously, if there's an employer who just obtained this year the registration, well, in that case, it should wait for 3 years in order to renew the registration. Well, in order to apply for this registration, we should generate it within 3 months before the license expires for this registration. The renewal module is only accessible during a specific period of time, and that is defined by the Labor Ministry. The platform will automatically disable the renewal module after the license period has expired. And in that case, if the registration is not renewed, it would be canceled. And the registrant may face sanctions under labor, tax, and social security laws. So it is very important for this year to keep in mind that we should renew this registration. After we have a successful renewal, the registrant or employer in this case will receive a renewal notice and must inform all customers of the renewal. This should take up to 10 days to receive the final renewal from the authority. And this new register must also be sent to all our customers in order to comply with all the REPSE regulations. And then another important aspect in the labor side that we saw during this year is the part that regarding the profit sharing. Back in 2021, the profit sharing was capped to 3 months of salary of the employee. And now the Social Security Institute, through its internal technical consult, has defined that any profit sharing exceeding the 3 months cap must be integrated within the Social Security salary. And also additionally, if the profit sharing is paid after the 60 days of the submission of the company's annual tax return, it has to be included as a variable salary for Social Security. So we need to pay always the profit sharing in May in order to avoid this new regulation from the Social Security. And it is also important to comment that for the Social Security, those who advise, counsel, provide services, or participate in the execution or implementation of the aforementioned practices will be considered that they are performing an improper tax practice for Social Security matters. So in our opinion, we should comply with these new regulations in order to avoid any sanction or any fine in this matter or any other additional payroll burden. And another important factor that we faced this year was that the new fine when an employer lacks of a registration for Infonacot. As you probably know, since 2012, it has been an employer's obligation to affiliate the company with the Infonacot. So the workers may be subject to a credit provided by the state entity, But until before this reform, the law did not establish any particular sanction for its breach. So, well, in this case, with this reform, it was confirmed that employers who do not comply with the obligation referred, they will be subject to a fine of 50 to 1,500 UMAs, or about 5,400 pesos to 162,000. That would be the worst case scenario in case the authority doesn't get the comproval of the registration. So it is, I think, an important factor that we should consider. And in the next slide, we also included the previous one, please. Okay, there was another reform regarding the employment subsidy, which is paid within the payroll. And after more than a decade without any updates of this subsidy, this was updated in May 2024. Now an amount of 390 pesos is granted to the workers with a monthly salary of 9,081 pesos or less. It is important to note that this subsidy does not apply in the northern border area, since the minimum wage there is higher due to the last minimum wage increases. So it only applies on the rest of the country. And then in June 2024, a decree was published in the official gazette reforming the Article 286M that establishes that the Social Security Institute will carry out notifications, summons, demands, requests, or solicit reports or documentations, even issue resolutions and inform the individuals about matters of interest to the IMSS mailbox. So in that case, any notification received through this mechanism will be considered like an official one. So it is important to activate the digital mail and then review on a daily basis, or at least on a weekly basis, this digital mail, just to be sure that we are in compliance and pending of any request from the authority in this case. And even though there was another reform in the general law to prevent, punish, eradicate crimes in the matter of human trafficking, on a fair side, it seems that it shouldn't affect the payroll or the employer's activities, but we think that it is relevant because this reform is considering that when an employer forces an employee to work more than the regular or the allowed schedule or hours per week, then that practice specified, or I mean that this could be considered like a violation and may be considered as a crime. So on this part, we recommend reviewing your internal policies to authorize overtime and contact your labor attorneys and consultants for assistance. It is important to justify when an employee works overtime in order to avoid any situation regarding this new reform. So, and that would be also more relevant when the new work schedule takes place probably next year. And now, well, in the next slide, we will review the labor reform initiatives. I think there are lots of initiatives, but these are like the most likely to occur. We would start by the reduction of the work week. As most of you probably know, Mexico has a cap of 48 hours per week for work. And well, it seems that this reform is a sure bet. However, it is most likely that this will occur in a gradual manner. Probably the decrease will be done in like 2 or 3 years period. So this change, this would affect especially within the maquila and the manufacturing industry, and probably others like the service or administrative position wouldn't be affected, but it is important to consider like probable reforming for next year. And then there's also an increase in the paternity leave days. Currently, we have 5 days of paternity leave. It is there's this initiative that considers 20 days, or if the baby or the mother has any complications, it can be extended up to 30 days for these benefits. And then there's when an employee is terminated, for some cases, the employers are obligated to pay a seniority bonus, which is consists of 12 days of salary. There's a proposal to increase it to 15 days. But well, since this is not for all the employees, just those terminated, probably wouldn't have a big impact for the cost of the payroll. But that's something that we should consider for the near future. There's also an increase, a proposal to increase the vacation premium, which currently, when an employee takes vacation days, and the employers are obligated to pay 25% on the wages that they are entitled during that vacation period. And the proposal is to increase to up to 50%. And another benefit that should be affected by a reform would be the Christmas bonus, which usually has to be paid in December. And the proposal consists in raising from 15 to 30 days of salary. And it is pending to be reviewed by the Legislative Studies Committee, but it seems also very likely to occur. And finally, we have the share law, which we in this proposal known as the SIGA law seeks to prohibit employers from requiring workers to maintain standing for the entirety of the workday or to take a seat periodically during the performance of their duty. This was actually approved on October 2nd in the Chamber of Deputies, and it is most likely that it will be outright by the Senate in the next few months. So, well, all these reforms represent the benefits to the employees, as you can see, but they also would affect our payroll budgets. And it is important to keep them in mind in order to know our possible payroll burden for the next year. And I think that in summary, Mexico is trying to adjust its labor legislation to comply with the international standards for labor matters. And we, as you know, we used to have rules that were created a long time ago. The work week was created like 100 years ago. And well, currently we live on other conditions and a different reality. And since this is a positive thing for the employees, it would be a challenge for the employers due to the increase of cost and activities that we may control in the next future. And finally, for the labor side, I would like to comment that regarding the minimum wage for next year, it is expected that the increase will remain in the range of the 20% as in this year. That will be a tendency, we think, for the next years, and this would generate a domino effect as in the recent years, with not only with the employees who obtain the minimum wage, but also the supervisors, and at the end, all the payroll positions should be benefited by the increase of the minimum wage. And for the labor side, since I think that would be all, and we can go on with the next topic.
I would like to introduce to our next speaker, Montserrat Colin, partner of International Tax and Transaction Services. So, Monse, thank you very much.
And hello, everybody. I just want to say that I know this is a hard topic for Tuesday morning, but I will try to make it as easier as possible. For international perspective, we have, I believe, three different focuses that we need to be aware of. The first one is, for sure, as you already know, since this year, we have the implementation of the MLI, the multilateral agreement between different countries of the G20 and members of the ECDE to try to regulate kind of these rules that we already know, these actions, the BEPS actions, which is base erosion profit shifting, which the OECD and all the countries identify some of the structures that could cause this base erosion profit shifting in some of the countries because of the use of hybrid instruments or permanent establishment and some other structures or ideas that we saw on the international structures. So in this sense, since 2024, Mexico are already in place this multilateral agreement. And I just want to mention that we have, this is like a game. If we want to see what would be the implication for the Mexican companies, what we need to see is if for a play, we need two players. So we need to be aware if Mexico is playing in this particular rule or is not. So what I want to mention is that Mexico and all of the countries could have a partially reserved, a totally reserved, or could be completely into the disposition of the MLI. So in this case, I just want to try to make a brief of what could affect two Mexican companies. First one, arbitration is completely excluded, so it means that we are not under this rule of arbitration. Friendly procedure, Mexico also reserved its position, so we don't need to really be aware of this topic under the MLI. What could be interesting, and I think this is really a very big topic. When we are using this kind of companies or instruments on foreign companies that could be considered as a pass-through entities or as a kind of an agreement or something that is an hybrid instrument that not necessarily is considered as a company or as a legal company or tax company, we should make this analysis. So we have I just try to break into 3 parts this analysis, because for sure this is my perspective of it. If we have on the MLI, we have particular comments on the hybrid instruments, even though Mexico make a reserve on this Article 3 of the MLI for hybrid instruments. What it means is that we are not necessarily applying the MLI dispositions on hybrid instruments. And this is very interesting, because Mexico and some other countries are the ones that push a lot to try to implement these hybrid instruments rule under the MLI. What happened in the history is that Mexico implemented that under the Article 4A and 4B on the local law. You remember this article that is so crazy to try to interpret and implement it. But we have this rule. And one of the questions that my clients come with is that, do we need to apply that article, or do we need to review the MLI, or what we do with the tax rate, double tax rate? So my personal perspective is that if under the tax treaty we have a regulation or an interpretation for pass-through entities, hybrid instruments, we could implement the double tax treaty. If we have not any definition, we don't have any definition on the double tax treaty, we need to apply the 4A and 4B to see if what would be the implication. But also I put in a different basket the US double tax treaty, because as you know, the USA double tax treaty with Mexico is not under the OCDE rules. So it's a different treaty that has a definition for pass-through entities and how could be treated for tax purposes of the double tax treaty. The other topic that we need to be aware of is the permanent establishment. We have new particular definitions under the MLI for auxiliary activities, so that's something that we need to be aware of, because under the double tax treaty, or probably under the double law, the local law, we don't have a definition of permanent establishment, but we have an extent of that definitions under the MLI. And the other one that is so relevant is principal purpose test. Probably you see, some of you see this article under the law, which is the 5A article. And this is an article that everybody is aware of, and also is so afraid of it, or the implementation of it for the tax authorities' perspective. This article talks about the business reason. And you know that this business reason could be interpreted as if our economical benefit of what we do, restructure, foreign payment, or capital redemption, or any activity has enough business reason more than the tax benefit. So, or if we make a series of multiple steps instead of making just one step, just to trying to obtain a tax benefit. That's a rule that is so far away and could go for any activity. And also we have this principal purpose test that is under the MLI, and this kind of test is not necessarily as expensive as the 5A article in the local law, but it's like a checklist that we need to go for it and see if it applies. One of the questions that came into this topic is that do we need to apply, if we are applying a double tax treaty, do we need to apply the principal purpose test, or it will be applicable the 5A article? Unfortunately, we don't have a definition by our tax authorities yet, but what we were discussing different panels and different groups of international tax specialists is that if we are applying the double tax treaty, it makes more sense to apply the principal purpose test instead of the 5A article in relation with business reason. Can we go to the next one, please? Next slide, please. Thank you. And this is just something that everybody should hear something about it. The pillar 2. As you know, I'm just including here like a timeline to see how was this implementation. Do you remember these BEPS actions? And then we have all the MLI in 2024, and we're expecting them probably in 2026. Like I remember when these global rules came out, we were thinking that probably 2025 will be the year, but probably would be 2026, the implementation of this pillar 2. Next slide, please. Okay, and this is super relevant. What is this BEPS rule and this global minimum tax rate of 50%? I think that we should be aware of that we have two things, pillar 1 and pillar 2. Pillar 1 is very focused on digital economy for these biggest companies that are doing these operations through the digital economic environment. And pillar 2 is something that what happened is that we have a group in the different countries, and we have countries where we pay 30% like in Mexico, but we have some other countries where the tax rate is not as minimum as should be. So what we should have in mind is that the key objective of this pillar 2 rule is that we have a minimum tax rate of 50%. And one of the things that also came is it is applicable to all the companies or not. At this point, we have over 140 jurisdictions that are working together to take out this rule on their local regulation or double tax rates. It will be applicable to multinational entities. So we have to have companies in different countries, and also we need to be aware of two things. The first one is the global income. So the global income of the full multinational group should be up to 20,000 million euros, and also the profitability should be over the 10%. So it's not necessary for everybody, but we need to be aware of where our global income is and also where our profitability is. Can we go to the next one, please? This is also a timeline that is more technical timeline, but it's something that we need to be aware of. And also, I think one of the things that should be relevant is that we as a company, as a group, familiarize with the different concepts that we have on this new regulation, which is not a new legislation. It is important to mention that this is a complementary tax. It is more related to income tax, not to indirect tax, not to other taxes. It's like income tax, but we need to be aware what taxes would be as qualified taxes. And also, we need to take into account this new concept that we have in place. I think one of the things is we have a regulation, a big regulation, which is called GLOBE. This is a GLOBE anti-base erosion rule, and we need to think about what taxes would be considered as common as taxes under this rule, and also would be considered the full of it as complementary tax. The tax could be paid under 3 different mechanisms. The first one is the income inclusion rule. The second one is under tax payment rule, and the third one is qualified domestic minimum top-up tax. So we need to take it into account the 3 of it, and then we need to identify if we need to pay a complementary tax. Next one, please. As I mentioned, this is a kind of the scope, the concepts that we need to be aware of it. And also it is relevant that if we are making this analysis for our group of companies, we also need to be aware what happened on transfer pricing rules. What is our structure for transfer pricing, and also see if we could be under any exception of the rule. For the next one, please. Next one. Okay, this is just a computation of the ETR. Is not is logical. Is not as simple. but it's not necessarily as complex. We just need to see and be aware of what the tax authorities will, or the Mexican government, how they will implement this new regulation on our local law. We are expecting probably a new law, probably an inclusion under the law, but would be a complementary tax. We just need to be aware what would be the way of implementing that. Also, we need to be aware of how this rule will be implemented for accounting purposes. There's a lot of uncertainty on how this needs to be recognized, but it depends on how legally will be defined in each of the countries that it will be implemented. The next one, please. And this is just kind of the relevant legal resolutions that we have. We have a sum of international precedents in Mexico. The first one, and probably most of you already hear about that, is the one that talks about technical assistance. This is a particular case with the Netherlands, and it's a case that it reclassified the technical assistance as a royalty. This is a precedent that take the double tax treaty and take us back under the interpretation of the context of the treaty to the local law, to mention that this technical assistance should be considered as a royalty, and in that sense would be subject to withholding to 25% under the local law, and not applicable the tax rate of the double tax treaty. And also we have another one that already, probably most of you already hear about it, is the standardized software. And we have some others in relation to permanent establishment. We saw some cases where the companies go trying to obtain a VAT refund, and then we have a new questions about from the tax authorities in relation to probably a permanent establishment and some other cases. But my thing is that if you need some help on international topics, please find like a tax advisor. We'll be happy to help you in this process, and also to try to analyze what would be the implication of these legal resolutions, or the Pillar 2 or Pillar 1 to your companies. It is so relevant to familiarize with these concepts, and also to try to run the previous analysis for this group of companies. Thank you so much.
Thank you, Monse. And well, our final speaker, Blanca Montaño. She's our tax partner at Tijuana office. So your turn, Blanca. Thank you.
Thank you. So this part of our webinar is related to IMEX companies. And we're going to talk about the foreign trade fiscalization trends. But before that, I want to do a little introduction for IMEX companies, remembering that there's IMEX companies for foreign trade, and there's Maquiladora puras, or Maquiladoras for income tax purposes. Having a clear mind, or clarity that there can be two different definitions for this IMEX company, it's important for your operation in Mexico, if you don't have that as transparent as possible. Also, what is an IMEX company? An IMEX company, it's in the decree, and it says that you at least need to have revenue of exports of $500,000 a year, or 10% of your revenue of the exports. So that means that it doesn't need necessarily to be 500,000, but it has to be at least 10% of your total revenues. So can we start with next slide? Before going into how the tax authorities are behaving with the IMEX company and VAT certifications, it is very relevant to talk about the new VAT certification obligations that are going to be in force next week. The one is complying with Annex 24, Sections A and C. What it's relevant, and it's a kind of a little bit of a shock to the industry, is that the information contained in this Annex 24 that relates to your inventory that is in Mexico imported on a temporary basis, is that needs to be submitted electronically within 48 hours. So this is something I'm not saying impossible. It's you need to work with your company that provides this type of software, but the problem is there's no margin of error, right? Like before, you like had like more time, and probably your company had more time to review the what it's input in this system. Right now, with 48 hours, you gotta be doing the operations correctly at the first time. If not, there's not very, as I was saying, margin of error. You cannot like restructure in 48 hours, right? Also, it has to be sourced from the corporate system. This is also a very big deal. And another one is that it's essential to grant online access to the customs authority to comply with IMEX obligations. So you have to give them a user and a password. So in this case, we go into like privacy problems, because we have to bring this type of information to the tax or with the customs authorities through a free letter writing, and it's gonna be at the paper, it's gonna be at the offices. So this is one of the commentaries that I wanted to talk about you more, because it is something that you need to if you haven't heard about it, it is important that you check with your maquiladora, with your IMEX company, and with your foreign trade advisors. But we can go to the following slide so that we can keep up with the trends. The VAT certification verification procedure. So as you were also looking with Arnoldo, he was saying the tax collation has increased. Well, the review to the VAT certifications has increased too. So if you see from 2022 to 23, it had increased 35%. To 23 to 24, it has increased right now 10%, but can go higher. And this is relevant because the tax authorities are checking on compliance, which we already knew since the VAT certification came into place, right? That they wanted to check the compliance. They didn't have enough personnel, and probably right now they don't have enough personnel to review all of them like in 1 year, but they're doing their job on checking the companies with VAT certification. What they're finding as non-compliant issues that are frequent is the inventory control, that there's the scrap that is not recorded, what's going on with it, but also that there's not everything is documented in this Annex 24. There is merchandise that is not located. There's merchandise that was returned after the deadline, remembering that you have certain months to return. And finally, that the company cannot provide documentation proving the legal use and enjoyment of the infrastructure. So all these are points of compliance that if you have a preemptive audit, like internal audit, is important to do it. I'm not saying, well, if you could do it every month, it would be ideal, but have it on a regular basis. You cannot wait until the customs authorities comes and you don't know how all your compliance on VAT certification is. Why? Because we can see in the next slide how the customs authorities are behaving on cancellations. So what are the consequences of not passing your VAT certification verification? What you have is you can have your VAT certification cancel. So in 2022, you had 58 cancellations. In 2023, 78, and so on. The tax authorities is going to that point of canceling and getting it back. You can request it after the passing of 2 years. What happens if you lose this VAT certification? Well, all the VAT that you didn't pay on all those imported goods, machinery, equipment, which is like one of the highest amounts, and all the raw materials that you imported, all the VAT that got exempted, you will have to pay it. So, and plus surcharges, like the updates for inflation. So in this case, it is very important to have preemptive reviews. There's a 19-point compliance verification visit, and well, as I was saying, regular compliance checks internal, so that you can have your VAT certification on point. So we go to the next section of our webinar, that is related to IMEX companies, but now focus on IMEX companies, maquiladora pura, or maquiladoras for income tax purposes. So we can go in the next slide, that we're gonna be doing a recap in the next slide. This is a recap of what a maquiladora is, no? Like a maquiladora, it's a structure of operating in Mexico and manufacturing in Mexico. It's a good vehicle that has been here in Mexico since the 60s. So what this lets you do is that this maquiladora imports on a temporary basis the raw materials and machinery equipment owned by the related party abroad. Could be any of the countries that have a double tax treaty with Mexico. The maquiladora process the goods in Mexico, like manufacturer. There's need to be transformation, and then when it's done, return the finished goods abroad. So it's an export, but it's called a return. No? So this is a good process to do the manufacturing business for exporting goods. No, and the maquiladoras sector has been losing benefits since like the last years, no? But it's still a very good option to do manufacturing in Mexico. It still has a permanent establishment protection to the foreign company that not other type of structures of manufacturing structure have. It has the additional deduction of exempt wages. This means that the exempt wages can be deducted in 100%, which in any other company in Mexico, you can only deduct up to 53%. And finally, well, the VAT certification, this is like for all my IMEX companies, but it's good to point out that you would have that benefit of VAT certification. And in the next slide, we can see what are the requirements to be a maquiladora. I'm going to focus on the compliance with transfer pricing obligations for determining your tax profit, because this is one of the most important things that are having changes well the next year. So right now, you can up until 2024, you can have the safe harbor computation, that is the tax profit computed as the higher between 6.9% of our assets and 6.5% of our costs and expenses. And also, companies, maquiladoras, have the advanced pricing agreement, APA, using a QMA until 2024, the qualified manufacturing approach, maquiladora approach. So what happens in 2025? Well, up until now, there's supposedly in the law, there's no more option to go for an APA. So this leaves a lot of maquiladoras that are complying under APA on a very big limbo, because they are wanting to keep complying with APA. The margin profits are better than with safe harbor when you are asset intensive. So let's see what can we do for 2025 in the next slide. In the next, well, this is how we are right now. The APAs, what we were saying is we can use the APAs until 2024. However, there was not like a clear guideline until this summer of what type of computation could be done for 2020 to 2024, because the tax authorities kind of were saying that some kind of effects of COVID were gonna be input in the qualified maquiladora approach, but at the end they said use the same one of before of the 2019. So this is only give certainty to maquiladoras of what kind of QMA to do. Also, it's a very good practice to do this QMA every year. I'm saying don't wait like to do these type of adjustments until the tax authorities are reviewing your case, because that could take 4 years or 4.5 years at the end of the open years. And what does that mean? Like, remember that there's no exemption on surcharges and inflation, no? On inflation and the update of inflation. So you will have to pay any type of inflation over the income tax owed. So when you receive your resolution for previous years, you need, well, first, our suggestion is to get close to your transfer pricing advisor to see what's the status of your case. And also when you receive the resolution, well, you need to do the adjustments, you need to do amended tax returns and amended DMs and see that all matches, no? So what are the options for maquiladoras after 2025? Please, let's see it in the next slide. These are the options, and I'm not, and in this part we're not saying restructure. This is only that you can see there's other options. Manufacturing in Mexico, it has the advantages of location, cost of the cost of labor is better than abroad, and also the quality is good too. It's very excellent because there's a experience that has giving us of working the last 60 years in manufacturing. Not that we have engineers and we have top notch of knowledge on these manufacture different kind of process. I'm not, it's electronics, it's for the medical hubs, for aerospace, aviation, etc. No? So on this slide, you have the safe harbor maquiladora for 2025. That's the only way you will have it. The manufacturing vehicles on the left are all related for all the elements of the manufacturing facilities are on the foreign company, and if you go to the right, everything is in Mexico, no? So it depends on what are you up to say, you know what, I want to convert to toll manufacturing. You have to assess if that's what you want to do. Really, toll manufacturing is very similar to maquiladora, but it doesn't have the permanent establishment protection. Contract manufacturing, as you see, the inventory and the machinery equipment is fully owned by Mexico. So this is some figures for you to like ponder next in the next months. Please go ahead. So what are recommendations for next steps? Be alert for the publication of any decree or rules. Why? Because this means that for an APA, there's rumors that there might be something. We don't want you to get like excited about it, because it's only rumors, but there could be an APA decree or rule modification until the tax return of 2025. We would have like the option to go, but if you wait to do anything until that time and nothing comes out, well, you would have to do a safe harbor analysis. So right now, also the second step is conduct a comparative analysis of your current situations versus safe harbor to see how much like the difference. Probably you say, you know what, it's almost the same. Okay, it's not, it's very high. Do I want to keep this working like this? Probably it's better than transitioning to other manufacturing model because of the cost of doing that transition, and evaluating the models, and assess the tax implications of any manufacturing model transition, because it's not easy. As you can see the next slide, there's several factors to ponder that. These are just like the main topics. I imagine there are like 100 of issues to do, but like if we transition to another manufacturing model, could be we would need to do a reportable scheme that those were enforced since 2020. We would have to like defend our case or do a defense file of the business purpose of this transition. We would have to see how to transfer the machinery equipment and raw material from the from the US or from abroad to another, from the Mexican company, where there would be probably VAT because these goods are in Mexico, and there would be also a tax withholding. Our manufacturing agreements would change, because before we had the Maquiladora agreement with certain margin, and now when we go to a tolling or a contract, we would have to see if there's no risk of permanent establishment, because we wouldn't have any more protection. And finally, like, well, at the end, if you're going to stay with safe harbor, you need to check on the key areas of opportunity for achieve fiscal efficiency. And that is not paying what is needed, but not paying like something because we just have it in your balance sheet. So we can see this in the next slide, please. This is the safe harbor profit. We can go to the next slide, because we already had talked about we're going to pay on the highest between 6.9% of our assets or 6.5% of our costs. And this is also something to review on how you compute the base of every of the costs and expenses or the assets. It's very important that you have a detail on this detailed computation, because this is what your company is going to be paying taxes on if you're a safe harbor maquiladora. And we see in the next one, this one is what I would like you to focus a lot, and the factors that directly impact maquiladora income. The account receivable with related party is going to affect your computation or how you pay taxes in Mexico, either your safe harbor or your APA. If you're safe harbor, any peso, any dollar that you have in an account receivable in your balance sheet is going to pay taxes. Imagine $100,000 times 6.9% times 30% of your income tax, and 10% of your profit sharing. That's how it's going to affect you. APA, if you have a turnover over 60 days, that the SAT will consider interest, and it's going to do an additional adjustment. So the account receivable, you can offset it against the payment of or the liability generated because of the distribution of of dividends. So the message here is there's options to offset or to cancel that account receivable, and you don't have to have it only in your balance sheet, like just lying there and paying taxes. And finally, machinery, equipment, and inventory both affect safe harbor and APA. Both need to come from the books abroad, not from pedimentos, which is a generally like problem that we see in companies. And it's important for your inventory to have only raw materials, not anything labor, not overhead. And also for machinery equipment, to input only the things that you're using. Sometimes you have a line of production line that it's not used. You shouldn't consider that. And finally, cost expenses, using only the cost and expenses that are related to the manufacturing, to the maquiladora, not to the other revenues. So for now, this is all for the maquiladora part. The message is all these changes, yeah, there's always changes. It's always good to manufacture in Mexico, and we can help you to go into this business, and you need some guidelines. Thank you.
Thank you. Thank you, Blanca, and thank you all speakers for your time. It was great information and discussion. However, due to the time, we are not having our Q&A session. We will be answering all of your questions. We will send you back our reply through an email. And basically, well, speakers, thank you very much for your time. We have reached out the time of our webinar. And thank you all for your participation today. Have a great day, and thank you very much again.